Guys, the reviews are in. SBA lenders are calling CorpSmart the best due diligence firm in the industry. CorpSmart is a one-stop shop for all of your due diligence needs, and in SBA lending, there's a lot. Searches, filings, vehicles, you name it. I remember I brought a deal in one time that involved an airplane. My credit guy looked at me and he said, "How are we going to go about perfecting a lien on an airplane?" I said, "I don't know, call CorpSmart." If you're not already outsourcing your due diligence, one, you're probably wasting a lot of precious hours that you could be using to go find more loans. And two, you could make a mistake, especially if you're lending across multiple states because every state is different. If you're looking to streamline and get more efficient this year, this is an easy layup. They can connect right into your LOS so you can order your searches with a click of a button and they'll appear right in their placeholder. To discuss your due diligence needs, visit the CorpSmart website at www.corp-smart.com and you can let them know I sent you. Hello and welcome back to the Art of SBA Lending podcast. I'm your host, Ray Drew. Today we're going to be discussing the future of the SBA 7A program, but before we look forward, we must look backwards. Now, while I haven't been around the entire time, not even close, I've interviewed dozens and dozens of industry veterans over the 5 years I've been doing this podcast, and I think I've got a pretty good sense of the history. So let's go back starting in 1984. This was the grunge era for 7A. Your boss would hand you a file, tell you it's an SBA deal, and to go figure it out. The banker would then head down to the local district office and talk face-to-face with the SBA on how to get it done. And 6 months later, they would have this weird, satisfying feeling of accomplishment mixed with PTSD. That banker was now considered an SBA expert because they'd actually gotten one closed. Fast forward to 1995, time to streamline. The SBA moved towards central processing and introduced the PLP designation. This was a critical improvement which turned the 7A from a product to an industry, and the money store was the lender leading the charge. The money store rapidly began growing its portfolio and becoming one of the largest originators of SBA 7A loans in the country. And probably for the first time, SBA was actively being advertised on TV and radio. Side note, the money store was later acquired by First Union Bank in 1998, but the cultural differences between a high volume, outside the box lender and, well, a bank created some challenges. They began dropping in the rankings that next year, and by 2000, First Union had shut it all down. That said, the money store left a lasting mark on our industry, showing how it was possible to market the program to the masses, create a streamlined process, and do a crap ton of volume. That brings us into the 2000s, where the internet was becoming the way of the future. The SBA knew they needed to modernize and focus on technology. Lenders like CIT, GE Capital, and Banco Popular took the money store playbook and ran with it. And as part of that playbook, the BDO model was solidified. And so instead of a guy at a bank waiting for a customer to have an SBA need, lenders were hiring people to go out and hunt for SBA opportunities. By 2006, CIT had 100 BDOs across the country. And then 2008 happened. Now, before we go on to the post-Great Recession era, there's one other notable thing that happened in the 2000s, and it's a pivotal part of the 7A story. The SBA 7A program faced some challenges in 2004 due to a temporary lapse in funding, resulting in a suspension of loan approvals for several weeks. This shutdown highlighted the program's dependence on congressional appropriations and led to talks about how to ensure the stability of funding for the SBA's loan programs. Spoiler alert, we're still trying to figure that out. But as a result of this challenge, the idea of making this a zero-subsidy model was born. This meant that the program would be self-funded through the fees paid by the lenders and the borrowers. So I'm going to put a pin in that, but we'll come back to that. All right, this is where it's going to get a little bit easier for me, because this is the time frame I started actually getting into the industry myself. So let's skip ahead to 2010. The industry is dealing with the aftermath of the 2008 financial collapse. One big move that the government made was to increase the maximum loan from $2 million to $5 million. And the year before that, the American Recovery and Reinvestment Act was signed into law, bringing on the temporary 90% guarantee and fee waivers. Wells Fargo was the number one lender at this time, but Live Oak Bank and Newtek were lurking in the wings with plans of their own. By mid-2010s, the 7A program was having the best years ever. And by 2017, Live Oak Bank, a small bank that had started in 2008 with a plan to lend only to veterinarians, became the number one 7A lender in the country, overtaking the behemoth Wells Fargo. A story that's equally mind-boggling and inspirational. From here, we all know what happens next. 2020, COVID, PPP. PPP had more impact on the 7A than you might think because there was a high degree of fraud in the PPP program. And because of that, the SBA implemented anti-fraud measures in the 7A program, even though there was no fraud issue in that program. But I guess they needed to do something. And so PLP was ripped away from every lender in the country in the fall of 2023. And I'm, of course, talking about the introduction of the risk mitigation framework that stresses out every closer in the country. Now, when you submit for PLP, you've got to wait for SBA to approve it. And sure, only takes a day or two in some cases, but in other cases, an error code appears and your mission is now to clear that error code. Obviously, a less efficient process creates more uncertainty and solves a problem that never existed. But that wasn't the only change in 2023, not even close. For the first time in 40 years, the SBA created new SBLC licenses. Non-banks lined up at the SBA for a chance of being selected. They awarded 3 licenses. 2 of them went to CDFIs and 1 went to Funding Circle, which was acquired by a company that's owned by a company that already had a license. So Funding Circle had to give back that license before a single dollar was lent, creating another black eye for the agency who opened up these licenses at the overwhelming resistance of the entire industry. But wait, there's more. 2023 brought in sweeping changes to the 7A program in the form of a brand new SOP. What was considered a small loan increase from $350,000 to $500,000. Partial change of ownership transactions were now allowed. Equity requirements were loosened up. Affiliation rules changed. And of course, the phrase "do what you do" echoed throughout every SBA conference in the land. These were all changes meant to streamline the process, make it easier for banks to make 7A loans, and attract more banks into the program. The SBA said at one conference that these changes were based on the feedback that we've been getting from lenders for years. So of course, the industry celebrated as these changes rolled out, right? Wrong. The industry was aghast. Their immediate response was, no, I don't like it. But what do you expect? No one likes change, and this was change. So here we are 1 year later, and we just closed out arguably the best normal year ever, and much of the uproar has died down. So maybe these changes weren't so bad after all. Maybe they were, dare I say, good? I think it's too soon to tell. Don't get me wrong, seeing the program grow like this is great, but it's really over the next few years that we'll see the impact. Are less guarantees going to be honored because of do what you do? Did loosening up the regs increase the default rates? And that brings me back to the zero-subsidy model that was popularized in 2005. Defaults have to remain at a certain level for the numbers to work. If they go too high, fees will most likely go up to offset it. Not the end of the world, but here's my concern. In 2005, we had a lapse in funding, and that led to something totally unrelated, a conversation about zero-subsidy. In 2021, we had a massive PPP fraud, and that led to something totally unrelated, fraud prevention in the 7A. So if the default rates go up and they're trending up, and if they get too high, what unrelated policy change will that lead us down? Will it be the end of the 7A program as we know it? Here to answer, we have a panel of Art of SBA contributors with us today. Bob Coleman, founder and publisher at the Coleman Report, Charles Rowe, president of Velocity SBA, and Mike Breckheimer, president and CEO of Windsor Advantage. Panel, thank you for being here today. Now, I promise we're going to get into some fun questions, but first I want to get your reaction to the sweeping changes in 2023. Charles, we'll go with you here. Now that we're a year into this, and the industry pushed back on all those changes last year, and here we are. Do you think the concerns, around do what you do and the new licenses and stuff, were those concerns warranted, or do you think they were a bit overblown?
Well, I think with respect to the issuance of new non-bank licenses, I know there was a great uproar, not only by the banks or non-bank lenders who are already in formation or have formed with the SBLC licenses, but it was just a general consensus of the overall industry. Now, luckily for us, we haven't seen a significant impact, positive or negative. It's been kind of a no impact as far as the SBLC licenses being issued, but there begs the question of, well, what's to come, right? There's always the opportunity that the agency could go ahead and issue more licenses. So that's kind of up in the air that we're looking for answers on. With some of the sweeping changes on the other parts of the SOP, I don't know about a lot of the other lenders, but I think most lenders, even including ourselves, we're looking at some of those changes. And I think we're kind of operating in a hybrid model where we're still looking at the old SOP, we're looking at the new SOP, trying to figure out, hey, how do we navigate through? Because there hasn't been a lot of, I should say, some kind of factual or some real live examples how lenders are navigating through and how the SBA is looking at some of those lenders and how these new changes are really being implemented out in the field. I think time will tell. I think we'll get some more answers in the coming months. But reality is, I really don't know any lender that has jumped onto the whole new SOP bandwagon and just all of a sudden changed all their underwriting and changed all their pre-qualification, just the guidelines overall to match the SOP. We just went through a risk-based audit with the SBA. We were now they were primarily looking at loans that were done in the past, right? So the results were acceptable, no issues there. But the reality is, how does this work a year from now, 2 years from now, right? So that's
Yeah.
something that we're waiting for some additional guidance.
Yeah. No, that makes sense. That kind of goes along with what I was saying. I mean, it's
Hmm.
probably too soon to tell, but
It is.
um Bob, I'm gonna flip it over to you here because do you think the zero subsidy thing is gonna go away soon? I mean, we're printing all this money, we're running up huge deficits. How does it make sense that the one program in government that fuels small businesses, the backbone of our country, has to balance their budget and doesn't get to partake in any of this slush fund stuff?
Well, first of all, Ray, thank you very much. I've enjoyed being with you this year, and it's been a lot of fun. So thanks for having me on.
Absolutely.
We do not know the black box of the subsidy rate calculation at the Office of Management and Budget. What we do know is that those large loans are profitable to the agency and to the government. That being said, you're not going to see too much of a push by SBA to to mess with that, and also by Congress. I was talking to the Congresswoman Chu. She's the number 2 member in the House Small Business Committee on the Democratic side. And I asked her point blank, I said, how come we haven't raised the $5 million? That's where the money is being made. And she nodded. She goes, I know, that's been stuck. And I said, well, maybe an easy solution is raise it up at least to 10 million, and you're going to create so much more of a net profit off this program, then that can truly subsidize the smaller loans that you want to do. So I don't see the subsidy going away. It's worked. It's worked for the last 25, 30 years. And I've always maintained this is a great, great public-private partnership. The agency does a good job on managing it. And the lenders are being very responsible on how they execute the product.
Well, on behalf of all lenders, Bob, thank you for, getting in Congresswoman's ear on that. That's amazing.
Well, you said we got to have fun, have some good news. I think, no, she's supportive of that, but as always. So I put it this way. There is not a consensus that says, no, we're going to cap it at that. If anything, we have to lower it. I don't see that happening.
If you've been a fan of the show for a while, then you know one of my favorite companies to work with is Rapid Business Plans. Last year alone, their business plans helped facilitate over $600 million in government guaranteed lending. They're on track to beat that this year. More and more small business lenders and their borrowers are relying on Rapid to help with the business plan, projections, and assumptions because their team goes the extra mile to ensure everything is done fast and done right. And that helps streamline the process. They're great at export business plans, by the way, which are critically important at protecting that 90% guarantee. Rapid also offers feasibility studies, which tells you if the project is, feasible. I would recommend these for any large startup loan because it protects you and it protects the borrower and helps you get more good deals done. Go to rapidbusinessplans.com to set up your Get Acquainted call today. Find out why so many top producing BDOs recommend Rapid to their small business borrowers. We're going to leave a link in the show notes just for our Art of SBA listeners. Now let's get back to the show. Mike, I feel like 2023 was a watershed moment for the program. What's your take on why the SBA made such bold moves last year?
Yeah, I think, and thanks again, Ray, echoing everyone else's statements. This has been a really fun season. Looking forward to your future content as well and how we can all continue to participate. I know the industry as a whole is tuned in and finding this extremely valuable. So appreciate it.
Thank you.
I think there was a lot of pressure post-COVID when looking at the amount of businesses that approach the need for PPP. Right, not just 7A, but just in general, looking at Main Street and seeing how many small businesses were really out there that at that time needed assistance, woke up kind of both sides of the aisle in the administration's eyes saying, we have to find ways to get smaller loans to those businesses that need it most. I think it was simply looking at the statistics and realizing that, an average of 25 billion a year of allocations is great. It's not really touching the masses of Main Street when it comes to the number of businesses that need loans. And I think they also saw that a lot of these businesses that they started collecting data on and started offering products to weren't utilizing 7A, right? And they weren't utilizing 7A for a couple of reasons. One, many businesses weren't educated in the sense of how to obtain a small 7A loan correctly and efficiently. And I think they were getting impatient. And then two, because of that, they were finding higher APR, shorter duration loans to solve their quick needs, but then kind of unfortunately being negatively impacted from a performance level because they didn't take the time to be able to focus on a 7A kind of 10-year small loan. And I think the administration realized that we had to be able to get that money, which is safe and borrower friendly. I always say this, there's no better debt product for a small business than a 7A loan when done correctly. They had to be able to expedite that process and make it easier. The gatekeepers of that were the lenders. And so if you look at comparing 23 to 24, right, I think we increased, 32 billion was authorized this last year, and the average loan size dropped by like 20%. So I actually think that those overarching changes that were implemented in 23, when simply looking at the last 12 to 18 months now, have been extremely successful. Windsor serves a broad market. We have, 100 plus clients that we speak to on a daily basis at this point. And many of those clients for the first time have started, because of the SOP changes in 23, started really saying, how can I get smaller dollar loans to Main Street? Because they finally made it a little bit easier with the raise and kind of the reduced documentation requirements on the small loan program. So I'm excited to see where it goes. And I think in the end, you asked why were the overarching changes pressed? Why were they implemented? I think they saw the writing on the wall with the amount of businesses that approached the program, good or bad, within the PPP world, and said, there's a really large total addressable market that the current 7A product 23 SOP changes just wasn't really solving for. And in the end, I think they're doing the right thing. I really do think they're trying to make sure that they're getting money to the right hands in Main Street that needs it most.
Yeah, there's a lot of good points there. And the average loan is coming down. So it's almost like, yeah, it kind of worked in a way. And I'm loving these numbers. I mean, production's up, the SBA is growing. That's all good stuff. Let's keep looking forward a little bit, Charles. So, we did an episode a couple weeks ago that talked about how the top 10 lenders now account for 33% of the program in terms of volume, and it's been trending up. And so I believe the SBA industry lags the mortgage industry with a lot of the different trends. You can agree or disagree with that, but Fannie Mae was created in 1938. 7A program was created about 20 years later. Here's what's interesting. In the mortgage space, the top 10 lenders account for 70% of the industry. Do you think the SBA will end up the same way? And if not, why?
Well, I think if you look at the production data over the past 4, 5, 6 years, you've seen quite a bit of switch, right, on the top 10, top 20, top 30 makeup in the rankings. And also what's really interesting is if you look at those rankings, the average loan sizes have come down quite a bit, right? And so as we were talking earlier about smaller loan sizes, smaller balances, that could be because of some of the SOP changes. I think that's also because of kind of mirroring what was happening outside of the SBA, meaning there's technology really being deployed. We've been hearing a lot about fintechs, and even last year when the SOP was changed to allow more SBLCs to come in and saying, hey, these fintechs are going to come in and they're going to take over and they're going to ruin the SBA program, et cetera. But I do think during the PPP and during over the past several years, there's been a look at how to best deploy technology. How do we get more advanced in the automation, the processing? And that perfect place to start is really with the combined changes in the SOP is doing the smaller balance, right? Because you can do a more condensed credit memo, et cetera. I do think that's going to continue in the SBA space. And I also think the smaller is probably the direction we're going to see over the next several years, despite the subsidy rates for the larger loans being more profitable, just because I think where the interest rate environment has been, the historically where you saw a lot of volume come through from a volume perspective, not a loan count perspective, was real estate. But a lot of the real estate loans have gone to other programs, particularly 504. Helped also by the high interest rate environment and the 504 with the better rate structure there with the debenture. So I do think you're going to see a growth in the 7A industry overall. I do think you're going to see a lot more of the top 10 lenders becoming more small balance, deploying technology to process those deals and gaining market share through those efforts. I do think, though, there's going to continue to be a shift in the top 10, top 20 on a go-forward basis as you have new lenders come in and become more active. You have some older lenders who have been in that market, may have some exposure, may have some portfolio issues, especially, depending on who you ask. Some people will say we're in a recession today. Some people will say no, right? The fact of the matter is, if you look at the default ratios, if you look at the early default, you could easily argue, yeah, we are in a recession, right? Because they are double what it was last year. So we are heading into, I think, somewhat of a kind of an interesting time over the next 12, 18 months on how some of the lenders survive through some of these defaults that they're faced with, and new lenders coming in and really taking on the industry and becoming more of the top 10. So I think you're going to continue to see a rise in the 7A volume with some new top 10, 20 lenders coming into the mix.
All right. Very interesting. All right. I'm going to switch it up a little bit here. Where do you think loan brokers fit into all this, Bob? Given all these changes and where things are headed, how do you see the role of a loan broker changing?
I've always maintained I don't think it matters too much if someone's a loan broker or a BDO. If they're an expert in the program, they can find a way to get the deal done. I think loan brokers are important to the program. You talk to lenders where it's well over 50%, 75% of their volume. That's going to continue, Ray.
How about BDOs, Mike? How do you see that role changing? Do you think it's going to be different? 10 years from now?
I really don't. And I think it's in a good way. I think from a BDO role sense, I still think that need for the BDO, for the relationship-based, creative credit line that has the ability to solve kind of a more complex transaction, that higher dollar level is always going to need to be there. I think what you're going to start to see, Ray, is basically shops, banks, non-bank lenders that have very successful BDO groups continuing to build those out for, say, like the $1 million plus, especially to Bob's point, if we ever do get that $5 million cap raised, you're going to have BDOs that really want to go out there and hunt for the whales in the bigger transactions. And that's really hard to do with tech. If you're getting a $5.5-6 million buyout loan, you're probably not just searching on the internet, right? And I don't see that changing. But what I do see is to Charles' point, is that, I mean, look at three, we all know the names, but like 3 of the top 5 lenders always are basically branch light, tech heavy national lenders, and their average dollar volume is dropping every single year. And they know what to invest in, they know how to market, and they know how to be profitable. They're doing it with small loans. So I think you're going to see institutions embrace the BDO broker model for bigger stuff. And the brokers aren't going to go after the small ticket stuff. You're going to start to see that come through digital marketplaces and probably fintech and strategic partnerships. There's groups out there right now. I agree with Charles in that, from what we see with our clients, which range all the way from, $30 million asset banks to $40 billion, most banks have not just completely looked at the SOP and rewritten all their policies and procedures to take advantage of the product. And they're just, fully out there trusting it. Everybody's kind of testing the waters at the moment, but almost every single one of our lenders has embraced parts of those changes in the small loan area to be able to utilize technology to gain a piece of a market share that they normally wouldn't go after. So in the end, I think it goes down to the economics, follow the money. The bigger loans that are the bigger ticket items are still going to be focused on with the relationship managers and the brokers. And the smaller ticket stuff is probably going to be absorbed by tech and marketplace matching.
So interesting. This is literally the last couple years you've really started seeing that people are thinking differently about small loans versus big loans. And that's kind of how it should be. And that's what the SBA wants.
I mean, we built like a solve for it, right? From demand from our clients who always say a $500,000 loan takes as long as to do a $5 million loan. So, but when you look at just our portfolio, right? Like our average loan size pre-pandemic was in the $1.1 million world, right? To Charles' point, I think we had a lot of lenders focusing on real estate, 25-year deals. It's supposed to be a cash flow based product, but Lord knows that credit departments still love that collateral. It's dropped by 50% since 2020 here at Windsor. Our portfolio's grown, but our average loan size, which I think is great because it's the purpose of the program, our average loan size is like $660,000 now. And so even just in our world, right, which is not, the new techs and the first internets and the bigger guys out there, even in our world, we're seeing kind of that mindset change of how do we use different product mixes to be able to truly get as much volume out there as possible. So I think it's a mix of the market demand and embracing some really good things that the SBA has done over the last 12 months. But to your point, and I'll be done, we got to track that data. And, I echo Charles' comments as well. We are seeing, the portfolio stressed a little bit. We're seeing borrowers that have, really felt that shake and that impact of, 500 BIP raise in less than a time period. A year ago, we all forget. I mean, that wasn't that long ago, right? That was 12 to 15 months ago at this point. So it's time will tell if, the portfolio can actually perform with kind of these new strategies. We probably need 24 more months.
Well, I was going to say, for sure, we're going to continue to feel the stress throughout, through the whole next year. And I think that's going to be a big year to watch and see what happens. But I'm going to do something here. We're going to do a little twist. We are going to do something we've never before done on this podcast, we're going to go into a speed round.
Uh-oh.
So this is different now. Okay. So we have more questions and we're going to keep the answers a little more succinct. And I'm going to go to Charles first. Charles, what's the biggest opportunity you see for lenders, 7A lenders here in the next 2 or 3 years? Biggest opportunity?
I think biggest opportunity is 10-year lending. I think that's what the product is best suited for with the very use of products or use of proceeds, I'm sorry, that 7A allows for. So I think you're going to see a continued growth in 10-year product versus 25-year real estate acquisition or refinance product.
Okay. Yeah, I mean, you're gonna need that 10-year product if you want to, do any numbers. Biggest challenge lenders face today when it comes to 7A lending, and how do you think they can overcome it?
It's still a people business. Talent, getting talent, recruiting talent, and keeping talent.
What's your advice on how they can manage that a little bit better?
Be good managers of your talent. Understand the different, understand what motivates BDOs specifically. You're not going to treat a BDO as you would a loan underwriter, and manage to people's strengths. Just old school management 101. Take
good old fashioned management.
Understand what you want to do, message that to your employees, and take care of your employees.
Yeah. So in other words,
secret.
don't onboard a BDO and have no one call them for 3 weeks and
don't onboard a virtual person and you wait 2 weeks to give them an email address and they don't know how to they don't know how to access the dashboard. They don't know how to do the password.
Amazing.
Simple stuff. This is not rocket science. Just take care of the business.
It's really not. Mike, how is technology impacting the 7A loan process?
Immensely. It's opening up doors for community lenders, local lenders, and institutions that normally wouldn't have a shot at competing. So I think it's going to continue to be embraced. I think the SBA is not the SBA themselves, but I think the industry in itself, from a lending perspective, is probably lagging, to your point, to that of the mortgage industry or some other more sophisticated platforms because of the addressable market size. And those that embrace it will be successful, and those that don't will start to see their market share get squeezed.
Okay. All right, Charles, what role do you see fintechs and the digital lending platforms playing in the SBA 7A market in the future?
I honestly, I don't know the answer to that. I think a lot of the SBA lenders are adopting tech, adopting automation. That is kind of the hallmark of the fintech space, especially with the small balance program. And I think that will continue to happen. I've always said, starting, years ago, that you got fintechs kind of on one side of the spectrum, you got banks on the other, and you're going to have to kind of come to the middle, right? It's like building the railroads. You got one starting in the east and one starting in the west, and at some point they're going to meet in the middle. And I think that's what's going to happen with respect to with the fintechs. Do they continue to be around with the same model? They've been successful because the banks they were competing with did not have that model, but the banks and everyone is jumping on that bandwagon. So how do they compete effectively if speed is out of the equation, right? 24-hour turn is out of the equation, and your local bank or your large national is able to do that or closely match that, and you were able to get price because of it, meaning you could charge 18, 20, 25% interest rate to do that. If that advantage is gone, then what's your value proposition at that point? So I don't know. Right?
That was a great analogy. I like that. The railroads. Bob, are there any emerging technologies that you think might transform the SBA lending landscape?
Well, I've said the AI is as much as transformative as the internet was. I cannot tell you how AI will transform our business other than it will be dramatic. Lenders who invest in it and who are aware of that and follow that are going to do well. It's a lot of problems. But put it this way, there's something there. And the lenders that figure that out are going to do very well.
Absolutely. I couldn't agree more. That's the answer, but no one knows exactly how.
Oh, we don't know the answer other than that's the answer, but we don't know how to get there. That is rocket science.
Mike, how can traditional lenders stay competitive against non-bank lenders and fintech companies in the 7A space?
Embrace the SOP. I'm not saying you have to do the minimum, but you have to underwrite an SBA loan the way that your competitors are underwriting SBA loans. Doesn't mean that you have to do as much of them. Doesn't mean you need to do certain risks, take risks in certain NAICS codes or areas. But understanding that, a 7A guarantee doesn't make a bad loan good. It makes a good cash flow based loan better. And making sure that credit and management are on the same page with encouraging their BDOs and their lenders to be able to find those types of deals is how they'll be successful. And then embracing the tech that is coming, embracing the SBSS score, embracing lender match, and realizing that you can lend outside of your footprint. And we are now in a digital era where most borrowers are expecting that.
Yeah, that's a good point. Because you can't, you can't just slap a guarantee on an A paper deal and expect the market to accept that. And then B, you can't slap a guarantee on just an absolute turd and make it a good deal. So
is that a financial term, Ray? I haven't heard that.
That's the core of what we do. So yeah, that's great advice. Let's see, where am I going now? Charles, what's a business strategy that an SBA lender should consider to differentiate itself from the rest of the pack?
From an operator perspective, for me, I see a lot of lenders chasing something. And for me, it's always been about the long game, right? I think there's a lot of lenders who are able to grow very, very quickly. And we've seen a lot of lenders then come back down. I mentioned earlier how this top 10, top 20, top 30 list, consistently has changed over the years, right? And I think playing the long game is really a way for you to differentiate yourself, be focused on the long game. I think the era that we're going into, there's a lot of change that's coming to the 7A business. There's philosophically, I think there's going to be some discussions around how do you operate this business going forward. A lot of people are just looking at volume and not really understanding how to handle these credit risks. And so I just, for me, like any business operator, not be focused on short term, but be focused on long term and how you're going to grow your enterprise. That's, for me, is just kind of sound advice I would give anyone.
I love it. So basically differentiate by being here 10 years from now.
Exactly. Because, just especially for non-bank lenders, you haven't seen that, right? You've seen a lot of non-bank lenders, they chase volume, they get into trouble, and then they either voluntarily or involuntarily have to pull from the business. And that's just not a good long-term, any strategy, in my opinion. That's not just a sound strategy. So I do think that's going to be the key thing. Let's see who's got sticking power, and let's see who does the right thing to make sure that they're taking really the best of the program and applying it soundly.
Interesting. So how does, Bob, competition in the SBA lending space impact rates and terms being offered to borrowers?
Well, you're always going to have competition.
But it's more now.
Yeah, well, but the other side of the coin, and I go back to what Mike was saying with respect to getting business. This is still a hand-holding business. We're not selling widgets. And what Wells Fargo will do is different than what Velocity will do, or a new tech and how they approach the transaction. So it is not a homogeneous market. So I understand this competition. I still think it is execution, is having the plan, identifying your market, and executing the plan.
Do you see that changing at all, though, with the sophistication of the small business owner? I mean, if you're becoming a small business owner today and you go and get an SBA loan, 5 years from now or whatever, like, is it different because of the resources you have at your fingertips now, and how maybe that hand-holding component of, and maybe not 5 years ago, but maybe 10, 20 years from now, do you think that'll ever change?
The bottom line is the small business owner cannot go to the internet, plug everything in, and get what they need. And where are they going to go? They're going to go to their peer groups. They're going to go to say, hey, I need to get a loan. Oh, go talk to Charlie over there. And that's still going to be there. They're not going to go on the internet, and they're not going to put all their information and hope for the best. They're still going to want to have that personal referral and that personal touch. So there may be more and more lenders out there, and the good operators are going to be able to message, this is what we do, get the word out, and have your BDO staff go out there and spread the word. That's the answer.
Okay. Mike, going to you next here. What changes do you anticipate in the 7A program over the next 5 years?
I think in the program itself, I think they're going to continue to try to solve with products, which I think is really interesting recently. And I applaud these new microloan programs that are being released. I applaud bringing in the CDFIs on the term loan side. I applaud this new ABL Lite 7A working capital product. Let's face it, there's probably a large amount of borrowers that are being placed into a 10-year term facility when realistically it would be more advantageous for them to have a borrowing based product on that ABL side. That's brand new, right? In beta testing. So I think over the next 5 years, if the SBA is continuing to exemplify what I think is a thoughtful way to say, how do we get more money to Main Street the proper way, safely, we're going to see more product opportunities. I think those that take advantage and specialize in those can really make a run at it, which I think could be really fun to watch and be cool. I think on the ownership side, I still think affiliation is funky, and when stuff gets loosened up, it creates some gray area. And so I'm interested to see how the SOP continues to approach affiliation. We tend to be very conservative with most of our suggestions with lenders. They still really try to focus on that 20% and make sure that those related parties are independent. So that's probably an area to watch. But I think if they continue to operate the way they have been, and the default rates tend to not skyrocket, right? We're going to be able to see things like partial buyouts and more innovative kind of advancements in the 7A product continue to grow. And the SBA is investing in tech. We all know that, right? Both on the servicing side and the front end. So I think we're going to have to become tech partners with them, right? Whatever this next new trend will be, they are going to continue to try to make it easier for lenders. We're definitely not there yet, as you know, but I think we need to watch out for that and make sure that we're embracing what they're giving us.
If I can jump in, what I find fascinating is SBA says they're a cash flow lender, and then you read the SOP, but we need to be 100% collateralized. What I would suggest over the next 5 years is that dichotomy is the answer. There will be an answer. Are we a cash flow lender and we're not worried about collateral, and we're going to bump up no collateral up to $500,000, or we're going to and focus on the cash flow, or are we a collateral lender? If they decide to go cash flow, then that's going to open up a whole new interesting realm of products to get out there for Main Street. So I'd be very interested. Ray, do me a favor, invite me back in 5 years, and let's see how they respond to that challenge.
Yeah, that's the fun part about doing this, is this stuff's going to be here forever. So when I do, like, I've been doing this now 5 years, and there's my prediction of this and that, it's still there, and half the time it's wrong. So
well, if you get it half right, you're awesome. Anyway.
No, it's funny. There's some fun stuff if you look back. So yeah, you have my word, Bob. You'll be back here to unpack it in 5 years.
I'll be there.
All right. So we're going to wrap it up here, Charles. If you could change one aspect of SBA lending program, the 7A specifically, to make it more effective, what would it be?
Oh gosh, that's a tough one.
Use your imagination.
Yeah, for me, I look at all aspects of the program, right? I'm involved with the daily activity, where the hangups are, all that stuff. I think it would be helpful, at least just from my personal opinion, that some of the recent changes and some of the processing that it takes. So if you're a preferred lender, you mentioned, yeah, pretty much the PLP program was done, right? You got to go through each trend, you got to clear all these error codes. I think that process of taking if you're going to give delegation to your top performing lenders, give them the delegation, right? It's right now, it's neither this, neither that. And it's this dance that we're trying to do, both sides. And I think it's a very cumbersome process right now for both sides. So it's something just immediate that I would like for them to take a look at and say, look at your lenders, take a look at your preferred lenders, how the portfolio is performing, look at their results from an audit perspective. And if you're really going to give that preferred lender status, then follow through, right? And trust that the lenders are partners in the program and they're doing the right things. And with the technology that they can sync, be able to decision loans quickly and give that delegation level to the lenders again.
Yeah, the only like, obviously we're running into issues on a high percentage of loans in terms of error codes, which are all getting cleared.
Right.
But the only one where it's like a real problem is the 4363. And those seem to be tied to fraud with EIDL and PPP, but it's not really, I don't know what it is, because it's potential fraud, right? So it's not, no, what do you call it? No charges have been filed or anything. That aside, like with all the other ones, it hasn't done it. It hasn't uncovered any fraud. You know what I mean? So we're going through daily issues every single day for no reason.
Right.
So I agree. So that's my long answer. I agree.
That you have to go through. Yeah. No. I mean, I'm sure we're not the only two lenders that feel this way. And like you said, majority of these get cleared, but sometimes we don't even understand why it's getting cleared, right? So, and I don't know if it's really having an impact as far as, is it working for what it was intended? Is it really preventing fraud? If you're clearing pretty much every one of these, what did it really accomplish? I'm not so sure. And there's good intention behind it, don't get me wrong, but I do think there's something there that just needs to improve overall for the program.
So I'm going to end it there, but I want to ask you guys, what do you think about the actual questions themselves? Not speed round versus regular, but like just the way the questions were written and asked of you. Like, what did you notice any difference between the ones that were asked in the speed round versus the ones that were asked in the beginning?
Yeah, I thought you left it a little less open-ended on speed round, Ray, and you got to the points quicker, which I thought was good. I kind of knew exactly what I had to answer, even if maybe I didn't do it as fast as I was supposed to. But I kind of knew what the answer should be.
All right. Well, this isn't like a pop quiz for you guys. I just thought I would sort of do something in the spirit of this episode and use ChatGPT to create all the questions. So, the speed round questions were 100% written by AI, whereas the initial questions were written by me, and it seems like there wasn't a big difference. But I thought that was funny. So with that, that concludes our 15 episode series of The Town Square. Thank you guys so much for tuning in. Thank you to all of our thank you to all of our Art of SBA contributors for being a part of this season. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The Video Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of the Art of SBA Lending. Ta-ta.